Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
Welcome to a new episode of Peachtree Point of View. And today I have Tim Witt, who runs our DST program, which is, our ability to invest, to acquire commercial real estate assets in a more tax efficient manner. But we're really not here today to talk about DSTs, but we're talking about another strategy that allows commercial real estate owners to be very tax efficient. And that's investing through a Roth IRA conversion strategy, which, Tim, I'll let you maybe sort of open it up and just, starting out with this Roth IRA conversion strategy. And the reason we care so much about tax efficiency is the fact that you can really grow your wealth and really compound your wealth over time by being very tax efficient. Probably one of the best and cheapest ways to grow your wealth is through tax efficiency. Sometimes that gets missed as people are trying to make investments. And that's why we want to spend time really talking about the Roth IRA conversion, because it was something I didn't really understand until recent. And I'm assuming most people listening today don't even understand how this works and how this could be super powerful for them to be able to grow wealth over the long haul, assuming they make the right type of investments. So with that said, Tim, I'll let you jump in just because you're an expert, obviously, with commercial real estate, but more importantly, with being tax efficient, through this type of strategy and other strategies.
Sure. Well, thanks, Greg. It's great to be with you here again. Let me say from the start a couple of things about what we're going to talk about. Is number one, we're not providing tax or legal advice with this podcast. And before you invest in any fund or offering that has tax benefits, you really should check with your CPA or tax advisor first to make sure that you can actually take advantage of those benefits. And also, one more thing before we jump in is that don't ever invest in a deal just for the tax benefits. You want to make sure that there's economic sense and that there's strong return potential to that offering first, and then think of the tax benefits as just kind of icing on the cake on top of that. When it comes to Roth IRAs, it's such a powerful tool because your money grows tax-free, which is the same as any regular IRA. But the difference is that you're not taxed when the money comes out. All your gains, your income, everything is tax-free when you take it out of that Roth IRA. And so the more money you can get into a Roth, it's a better, more tax-efficient growth tool. And we think about if you ever it's a regular IRA or even 401k and you pull up your balance, it's easy in your mind to think, hey, that money's all mine. But it's not. Some of it yours and some of the government's going to have a claim on sometime down the road when you're retired and you're taking that money out. And you're not knowing what the tax rates are going to be, 10, 20, 30 years from today. You could probably make a case that they're going to be higher, not lower. So there can be benefits. And again, when you're investing in a Roth IRA, those are after tax dollars. So whatever earnings you have, you're going to pay tax on that, and then you're going to invest into the Roth, as opposed to a regular 401k or a traditional IRA where those are pre-tax dollars. It is post-tax, after-tax dollars with a Roth IRA. The challenge is that it can be hard to get a lot of money into a Roth IRA. There are some limitations, and first is that if you make too much money, you cannot contribute to a Roth IRA. And so if you're single and you make more than $165,000 a year, you cannot contribute to a Roth IRA. If you're married and you make more than $246,000 with your spouse, you cannot contribute to a Roth IRA. Even if you're under those income limits, and if you can't contribute more than $7,000 a year or $8,000 if you're over the age of 50. And so while it's great to talk about getting a ton of money into a Roth, there's limits in terms of how much you can actually get in there. Now there are some interesting strategies. One, kids can invest in a Roth IRA if they have earned income. You have to have earned income, and so if you're self-employed, have your own business, you could hire your kids to do something and contribute and max out their Roth IRA every year. And if they did that between the ages of like 12 and 22, and that grew, tax-free until they're 65, would be very, very substantial. That's assuming they don't, yank the money out and blow it on something before then. But there's ways for that. But if you're just if you're 30, 40, 50, 60 years old and you're above those income limits, even if you're not, it's hard to get a lot in there. And so a conversion, which you're taking money from your traditional IRA and taking that and transferring some of that to a Roth IRA, now you're going to pay taxes on that conversion. We'll talk more about that. But that's one way to be able to contribute and get money into a Roth and not be subject to those limits for income or those limits in terms of how much you can invest annually into a Roth IRA.
So Tim, let me ask a question just to break it down. So basically, if I'm making more than, say I'm married and I'm making, $1 million a year, I can't I can't basically contribute money to a Roth IRA. The only thing I can do is take my existing 401k, I guess, or IRA, right?
It probably cannot be at your, like the 401k with your current employer. But I'd say probably the most common source of funds that people have to do a conversion is from a 401k they had at a prior employer. You leave your employer, then you can do a rollover to a regular IRA. Because if you leave the money with your employer's 401k plan, some allow it, some don't. But even if you can leave it there, your investment options are very limited. There's typically, some list of mutual funds you can invest in, but you can't invest in individual stocks, bonds, or other things in that company that sponsored plan. And so it's very typical for people to do a rollover from that 401k after they've left an employer and put into an IRA, whether it's at Schwab or Fidelity, E-Trade, someplace where they have unlimited investment options versus what's limited in their company's 401k.
So effectively, you got to have an IRA. So if you have an IRA with money in it, you can technically then convert it over to this Roth IRA strategy potentially that we're about to talk about how it works. Or another option is, if you make, say, you're married, you're a couple, and you're only making $100,000 a year, you're able to invest a certain percentage of that income into a Roth IRA, or how does that work? Just so I understand that piece.
Sure. So yeah, if you're under those income limits, then you can invest up to $7,000 a year. $8,000 if you're 50 or older. Now, if you're married, then you and your spouse could each invest $7,000 or $8,000 if you're both over 50 years old. So there's nothing wrong with doing that, and that's really compounds over time. Hit retirement, your retirement plan by just investing for 1 year. But if you can max out your Roth IRA contributions over 20, 30-year period and see growth along the way, in addition to what you're adding, that can become quite substantial.
So, and the reason I'm asking is if you're an accredited investor, if you're not an accredited investor, obviously our offerings tend to be focused on accredited investors or higher, or qualified purchasers or whatever. But if, either way you look at it, this is great advice for anyone. They should set up a Roth IRA regardless, or should have the ability to do it, because you can effectively grow the money you're going to invest tax-free by, if you're making under the income limits and you're not, you end up not being accredited because you don't have enough assets, that's fine, but you're going to grow your wealth. You're going to magnify your wealth by setting up this Roth IRA, strategy. Or if you have children that are younger, there's no limitation. If you have a child that's 14 or 15 years old and you could set up a Roth IRA for them, I guess it sounds like, right?
You can. They have to have earned income. So they could have a job, or if you have a 10 or 12-year-old son or daughter, they probably don't have a job outside the home. But if you're self-employed, have your own business, you can hire them to do something. They should be doing something real. They shouldn't just be playing video games, and you give them $7,000 a year to put into their Roth IRA. But it's really, the younger you can start, the better off. That just gives you so many more years for that Roth to compound and grow into a very meaningful amount of money by the time that you're entering retirement.
Right. This is great advice. So if you have children that are even really, if you're fresh out of school, if you're just starting your first job, this should be one of the first things you do is set up this Roth IRA, because this is going to set you up for potentially for financial success long term, no matter where you're investing your capital, because your returns are going to be much. Obviously, if you're making a 10% return, you're going to truly make a 10% return, because typically when you invest, obviously in taxable accounts, you got to pay taxes, and it can be short-term or long-term gains, and it's going to, impact your returns. But in a Roth IRA, if it's growing tax-free, effectively the stated return, assuming you're trading and stuff, is going to be that, because you don't pay tax on it, right? So
it's great when you're starting out, especially at college, you have your first job, and if you're not making a lot of money, the great thing is that you're in a very low tax bracket, because these are after-tax dollars. And so you're not taking a huge tax hit by doing after-tax versus pre-tax dollars. So yeah, huge benefit to starting as early as you possibly can.
Okay. So let's talk about the person that, is, that's built up some wealth within, an IRA. They want to, they've got, let's just assume hypothetically, they have $1 million in this IRA. They have great income, so they're not able to contribute more money into this, or set up their own Roth IRA, because it just doesn't work. But they have $1 million, technically in this IRA, or maybe they have 5 or 10 million, but let's use $1 million because it's an easy number. And they want to convert, a portion or maybe all of this into a Roth IRA, because assume hypothetically they're, around 50 years old, and they're like, hey, I want to really continue to grow my my financial wealth. tax-free, most likely taxes are going to be higher down the road. It's probably better to pay taxes today than worrying about it, 20 years from now, because we all know 20 years from now, just given deficits and everything else that's happening, at some point we're going to have to pay more in taxes. How does this person go about, basically converting it in a tax efficient manner into commercial real estate projects?
Sure. So just talk a bit about the conversion, and really how that works is you're going to have two IRAs. You're going to have your traditional IRA that you contribute over time, or it's a rollover from an employer sponsored plan. And you're going to set up a Roth IRA. So you have two separate accounts. You will instruct your custodian, whether it's whatever firm is holding the funds for you, to transfer certain assets. It can be cash. You'll instruct them to convert some amount from the traditional IRA over to the Roth IRA. Now, the year that you do that's taxable income, and that's going to add to your income. So we'll talk more later about some of the tax implications to think about, because you are going to pay some taxes. There's no getting around that, and so you don't want to have a big surprise when it comes April 15th of the following year. But one of the keys to doing this conversion is being able to transfer assets when they're at a lower value. Let me give you an example. Let's say you bought stock in XYZ company at $50 a share, and you think, hey, you really like this company, you think it has great prospects. You bought, hey, maybe the stock's down, they're going through a bit of a rough patch, and the stock goes to $25, and maybe shame on you for not selling sooner, but a lot of people don't. I've done it myself many times, right? And so you're still holding the stock, and you don't plan to sell it because you really believe in this company's potential. That could be a great time to convert it from your traditional IRA to your Roth IRA when it's at $25 a share versus $50 a share. And so that's true of any common stock or mutual fund or any just traditional asset that you may hold in your IRA. With real estate, there's a way to invest in a real estate project, it'll be a development project, where you can make that transfer when that project is a lower value. And really how that works is, let's say you invest, let's say $100,000 into a real estate development project, and like the projects, Greg, that we at Peachtree do here all the time. When that project is midway through construction, we would have a valuation done on it. And at that point in time, it's probably going to be worth less than the $100,000 we put in. And for a number of reasons. But one, it's just there's certain upfront costs for development, there's soft costs, there's fundraising costs, and just a project that's half built is typically not worth a lot to somebody. And typically it's probably worth a lot less if someone had to. If you're actually going to take a half built project and try to sell it, you're going to take a meaningful hit on your value. And so just nature of that it's only partially complete. There's also discounts that can be applied because you're investing in an LLC, you're buying LLC units, or it could be limited partnership units. And there can be a discount on the value of those units because you don't have control. You don't have liquidity. There's a lot of uncertainty around, when you're going to get cash flow, when there's going to be an exit. And because of all those factors, there can be a discount around that as well. And so that's the time that we'd have a new valuation done. That would be the time that you want to do that conversion from your traditional IRA to your Roth IRA when it's at that lower discounted value. And then, after the project is, nearing completion, it's finished and stabilizing, that's when the value is going to return and hopefully, far exceed the initial $100,000 that you put in.
And so effectively, you're taking this hypothetical $1 million IRA account, and you could take a portion of it. You don't have to take all of, the $1 million. You could take 250,000, you could take 100,000, you could convert it into this Roth IRA, right? Or you would initially you would make the investment within the IRA. You would get a self-directed IRA to invest capital into, this commercial real estate project. That's a development project, to your point, because it needs to be something that is having value disrupted, and you're going to value it at the absolute worst time when it's midway through construction, effectively. Right.
That's correct. And also, you used a key term there, which is self-directed IRA, which we should talk about that. Because a traditional custodian, there's ones I mentioned before, Fidelity, Schwab, E-Trade, they're not going to let you buy and hold a private placement, LLC, real estate development project. And so you're going to have to have your money at a self-directed custodian that will allow for those type of non-traditional investments that are outside of typical stock, bonds, mutual funds. And there's a couple ones that we work with. I know there's CNP, there's Inspira. And so you'd want to open a IRA with one of those custodians, and then you're going to do a transfer from your account at wherever it was before to that self-directed IRA custodian so that you can invest in this type of real estate project. And on your question on the conversion, like if you have $1 million in your IRA, you don't have to convert all in 1 year. You can convert any amount. You may do 50,000 a year, 25,000, 200,000. You probably don't want to do it all in 1 year because you're going to have a massive, massive tax hit that you're going to have to come out of pocket for. So you have to make sure that you have the cash available. So most people do it in stages over a multi-year period. Now, even for a single investment, going back to that example I gave of a $100,000 investment into one of our real estate development projects, you don't have to convert that entire amount in 1 year. For example, let's say you bought it, let's say today, here in September 2025. And let's say in a couple of months, we have a new valuation done and maybe it's 30 or 40% lower. And we don't set that amount. It's a third party independent appraisal and they will determine what the new value is. And so let's say it's down to, 60 or 65,000. Let's say 60,000 because it's a round number. And so December, I could transfer $30,000, from my traditional IRA to my Roth. And then January, I could transfer the other 30,000. So I'm only going to pay taxes on 30,000 this year and pay taxes on additional income of 30,000 next year and not take that whole hit in one year.
Got it. And so let's just put math to this right now, just so people can really understand the power of this, conversion strategy. So typically if I'm investing in a IRA, I'm probably investing in more public securities. Some cases I may do a self-directed IRA and get the benefit of higher yielding alternative investments, or at least what usually is perceived as higher yielding assets or should be. So if I'm investing in the public markets on average, I think historically they produced like a 7 or 8% return, right, in the public markets. And I may be a little bit off, so people can fact check me there. But if you're investing in alternative investments, you're getting a higher yield. And if you're investing in development projects, that's typically some of your highest yields possible. There's risk associated with that too. So it should not, I think you said something very critical at the very beginning, where, you should really do your due diligence, because the quickest way to be tax efficient is invest in a bad deal because you'll lose all your money. You won't pay any taxes. And that's something we try to avoid. But there's always that risk associated with it. But with that said, let's assume you have an IRA, you invest in traditional assets, you're getting an 8% return. So for the next 5 years, you're going to make 8% a year on that $100,000 in an IRA. You're not going to pay any taxes till you convert it, right? So let's just say you hit retirement age, 5 years later, and you convert all of it, $1 million, because it's getting 8% a year return. It's grown to, you've got about $1.4 million. So you have $1.4 million in that IRA. When you've grown it at 8% a year, you've got to pay tax at what level when you convert that IRA to taxable account. Or you pull that money out, you're going to be paying tax at ordinary income tax rates, right?
Correct.
So effectively, you're going to pay 40% on the full $1.4 million. So you're going to effectively, if I'm doing my math right, if you pulled it all out day one, you're going to pay $560,000 in tax, right? On that day. So you're going to net, call it, if I'm doing my math right here, you're going to net $840,000, right? After paying tax. And this is just very quick math. Whereas if you do the strategy where you take $1 million, you invest it into a commercial, like a development project, and you get it valued at one of the, lowest points, usually you're probably going to see a discount of potentially, and it varies. It could be no discount technically, but on average, you would expect it to be a 30 to 40% discount.
That's correct.
Yeah. So assuming it's a 40% discount, you're now going to pay tax on that $1 million. Assuming it's a 40% discount, you're going to have 600,000, and you're going to pay, assuming a tax rate of 40%, because it would be ordinary income tax rates, right? When you do it, you're paying tax of $240,000. Okay. So you're paying a lot less tax. And now that money you just converted over, that $1 million, technically should be growing hopefully at a 12 to 15% return. But let's just assume it's 10% a year. So you're getting that $1 million investment, because you still have $1 million investment. It's just a phantom loss that you're taking theoretically, because you're not liquidating. So 5 years later, it's worth $1.5 million. But if you decide you want to pull that money out, 100% of that's tax free, right?
That's correct.
Yeah.
But with the caveat that, when you do a Roth conversion, the funds have to stay in the Roth IRA for 5 years to take it out tax free. But
Right.
typically, I think this is it's most efficient for someone that has some amount of runway to still invest. And so if you're 75 years old, maybe it doesn't make sense. But if you're young, then holding it for 5 years is it's in a situation where you're not planning on taking it out within those 5 years. You're just planning on having it ride and grow for some period of time.
Right. I know we're running out of time here, but just to really summarize it, like using this example of that $1 million, by you just investing like you normally would versus investing through this strategy, I mean, it's potentially game changing for your personal wealth, because potentially you're going to end up like in this $1 million example, your wealth could grow by well over $300,000 just by just executing on this strategy, by doing nothing different. So it's it's hugely impactful. But just one thing that love for you just to explain, because I think it's a big part of the strategy before we close this out, is can you really walk through the J curve strategy, like how that works, so everyone just fully understands that, because I think that's a big part of this equation.
Sure. Yeah. I wish we had a graph on the screen for everybody to look at. I know we have a fact sheet that we've put together that you can request from anyone here at Peachtree, and they can provide to you. But it's really starting out, as we talked about. Let's go back to the $100,000 example, just because it's an easy round number to talk about, right? So I invested $100,000 in a development project, not in my Roth IRA, but my traditional IRA. Midway through construction, and simply at the point where most of the cash is spent down, and now the project's starting to draw on their construction loan, and the project isn't near completion yet. That's the ideal time to do a new valuation. It's going to give you the lowest possible. You want to do it at the very bottom, kind of at the graph where we're starting up here. It's going to come down. You want to really target that lowest possible point to maximize your deduction and minimize the amount of taxes you're going to pay and doing that conversion. And then from that bottom point, you get the construction continues, the project gets completed, you get through lease up, and as all that happens, the value is returning. So that 100,000 maybe becomes, 60,000, after we do the new valuation. And then you're hoping that, at some point that 100,000 becomes 150,000. I'm just using some very round numbers. And then at that point, if it's a development project, a sponsor's goal is to stabilize and sell as quickly as possible. So it's not a project that you shouldn't plan. You're hoping not to be stuck in it for forever. You're hoping that it gets built, stabilized, and sold. Now you have this much higher dollar amount to reinvest in other investments. And you may go back into more real estate development. You may do some of that, or credit, or other things I know that we offer here. So that's really what it looks like. And then, before we run out of time, we really should talk about the taxes too, because it's a meaningful part of doing this. And so the amount that you convert, which hopefully it's at a lower value than what you put in, that is taxable income. And so it can impact the tax rate that you're in. It could put you into a higher tax bracket. It could subject you to certain phase outs. So let's say you have 3 kids, you're getting the child tax credit. Well, all of a sudden, your income increases to the point where you've lost your child tax credits, right? So it doesn't mean you don't do these things, but you really should understand fully the implications of how it's going to impact your taxes, for this year, next, and the year after before you invest. And so I think about that. The custodian will issue a 1099-R. So if I put in 100,000, it gets discounted to 60, and I do the conversion of the 60,000 over to my Roth, the custodian will issue a 10R for that $60,000, which is also reported to the IRS. And then when you file your taxes, there's a form that you will use. It's a 8606. That's where you report a conversion. And so your CPA will help you work through all that. And then again, you don't have to convert all in 1 year. And it may make sense to spread this out over multiple years to minimize your tax impact in any 1 year. And if you have that $1 million example that Greg's talked about, it doesn't mean you should invest in one development project for $1 million. It may mean I'm going to do 100,000, 200,000 in this project, and then 6 months or you later convert it, and then next year you're going to invest in another project. They're going to spread that and really spread your risk across multiple projects, because you don't want to have one project that has an issue.
You definitely want to diversify out. You never want to be exposed to one market, one that type of asset, to one vintage, being like 1 year of investing. Like we've learned, you can invest in the wrong year too. It's always good to, I totally agree with where you're going with that, Tim. You want to be diversified out, and you want to, I think the biggest thing too to this is understanding that, tax efficiency is a great multiplier of wealth. It's a great way to compound your wealth when you make a good investment decision. But if you're not making a good underlying investment decision into an asset, it doesn't matter, because it'll be, if you're tax efficient or not, it'll be a bad investment. And when it's a bad investment, you'll be the most tax efficient possible, because you'll pay zero tax for sure, because you'll have a total loss. So,
well, in a Roth, we talked about there's no tax on your gains. Well, there's no benefit on losses in a Roth. If you lose money in a Roth, you don't get to write that off your taxes. Just so you want to be very thoughtful in terms of the quality of the projects that you're investing in.
Right. Well, Tim, we really appreciate you coming on. I would recommend, if you're someone that loves to be more tax efficient in how you approach investing your capital, I would highly recommend taking a look at the Roth IRA strategy. We're always happy to be a resource. This is a strategy that we're executing on internally ourselves. This is a complement to what we even do on the opportunity zones, which is somewhat similar to, there's a similar type discounting mechanism that occurs through those projects, especially the ones being done right now, just given where we sit in the change from the initial program to the new program that's getting ready to come out here shortly, or will become in service in 2027. But that's another way to invest capital, that where you have capital gains. In that program, you have to have actual capital gains where you can defer it out for a small period of time, but then also 100% of your new gains will be tax free. So if you have gains on the new investment, 100% that'll be tax free as long as you're invested for 10 years or more. But we always have other strategies, and please feel free to reach out. This is, I'll just close it out, that we really appreciate you listening to Peachtree Point of View. And we'll have more episodes here shortly that are talking about different ways to invest into commercial real estate or invest with tax efficient strategies.
Right.
So thank you.
Thank you, Greg.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.